Lesson number 1. Learn to read the logic behind candlestick patterns instead of memorizing Japanese candlestick pattern names. If you don't know how Japanese candlestick patterns work, I have a free ultimate beginner's guide that you can watch right now in the video card. If you already know these patterns, you know that there are around 50 different patterns to memorize, and it takes a lot of brain power to remember and apply all of that in real-time trading. An easier solution is to learn how to read the simple logic of the 4 prices in a candlestick. That's the open, high, low, and close. The candle body shows intention, while the candle shadows show where the market has been during the formation of the candle. A bullish body means buying intention, while a bearish body shows selling intention. A large upper shadow means selling pressure, and a large lower shadow means buying pressure. Learning rules like this will allow you to read any candle formation you wish, which is a lot easier than memorizing too many different patterns. Lesson number 2. Learn the logic of supply and demand. Supply and demand is the driving force behind price action, so every trader should understand how it works. If you grasp how supply and demand works, you will grasp the rules of the game of price action. I also have an entire free course here on YouTube about supply and demand trading if you don't know how it works. Lesson number 3. Learn different trading approaches. New traders will often get trapped into one type of trading methodology and they attempt to master it, which is valid, but there's also value in learning other methodologies in order to enrich the trader's perception. There are many different perspectives through which you can see the market. I will make a brief list of them so you can do some research. There's Dow theory, market phase analysis, trend analysis, volume analysis, raw price action reading, window oscillators, overlay indicators, divergence analysis, momentum analysis, Fibonacci analysis, envelopes and price containment methods, chart patterns, Japanese candlestick patterns, point and figure charting, market profile, Elliott wave analysis, Gann analysis, cycle analysis, volatility analysis, Ichimoku charting, Renko charting, market breadth, sentiment indicators, behavioral techniques, quantitative trading, algorithmic trading, econometric models, and so on. The scope of knowledge that surrounds technical trading never stops expanding, so if you want to become a master at this, you should never stop studying. Lesson number 4. It takes time to become fluent at reading the market, just like it takes time to become fluent at a foreign language. When you learn a foreign language, knowing grammar, syntax, and vocabulary is not enough. You need to get exposed to conversation on a consistent basis in order to become fluent. Reading price action is the same. Knowing the rules of different trading approaches is not enough. You need constant exposure to how the methods are applied in order to master them. That is a process that requires time and consistency due to the complexity of price motion. Lesson number 5. Price charts are the tip of the iceberg of any market. Whenever a trader looks at a price chart, he's looking at the final result of the battle between buyers and sellers, but he cannot see all the reasons that led to that final result. That is why technical trading is so vast. It has many different ways of attempting to capture the tension between buyers and sellers, but there is a lot more to the financial markets than what meets the eye of a trader through price charts. Lesson number 6. Screen time is important, but theory is paramount also. Some traders like to believe that the more time they spend on real-time charts, the better they will get at reading the market. That is true only to a certain degree. Theory plays a very important role as well. The ideal scenario is to know as much theory as possible and then spend a good amount of time observing how 7 different approaches play out in real time. The optimal solution is to align theory and practice. One is incomplete without the other. Lesson number 7. Learn how to read price bar by bar as well as the big picture. Each price bar or candlestick has its own story, and the trader must be able to perceive that story with a quick glance. However, a large collection of price bars or candlesticks also tell a story or context that cannot be seen by individual candles. It's the alignment between the focused perception and the overall context that provides a more refined reading of the market. Lesson number 8. You should be able to write paragraphs about a small piece of price action. A good price action trader is the one that is capable of extracting an enormous amount of information out of a small piece of price action. If you look at a price chart and not much comes to mind, it's a sign that you need to learn more about different price reading methodologies, or you need to practice more of what you learned, or a combination of these two things. A price chart, despite its limitations in comparison to the market itself, has an incredible amount of implicit information. Lesson number 9. Contextual analysis is the most powerful type of price action reading. Price action reading using non-lagging techniques in a contextual manner provides the best framework to make educated decisions about high-quality trade opportunities. The combination of non-lagging techniques with the ability to read the market bar by bar, as well as seeing the big picture, is the highest ability a price action trader can achieve. Lesson number 10. Price action is a complex system. That means it displays elements of order and chaos simultaneously. The financial market is considered to be a complex system, which the main characteristic is to display order and chaos at the same time. Most people think that something can either be orderly or chaotic, but these two elements are not mutually exclusive. That means sometimes trading is very easy and sometimes trading is impossible. Lesson number 11. Setups are mostly bad, but there are a few highly specific setups that are good. The goal of setups is to provide objective rules for trading. Even though this objectivity is desirable, it comes with a cost. Sometimes the market cannot be simplified to a small list of rules. That renders most setups as bad. However, there is a class of setups which are highly specific and still objective that can be used effectively in trading. The list of rules is larger and more restrictive, which makes these setups rarer. Lesson number 12. Always look for both sides of the market. Traders usually tend to look only for long or only short trade opportunities once they begin analyzing the market. That's natural once we start analyzing the charts. However, once we bias our analysis like that, we create a blind spot that makes us miss trade opportunities on the other side of the market. The trick is to always try to make a case for both sides of the market. Sometimes both long and short trade opportunities appear at the same time. Lesson number 13. Always learn the limitations of trading techniques. It's a common mistake to learn only the advantages of a certain trading technique and ignore its flaws. The lesson here is that you can learn a lot by understanding the limitations of various trading techniques. When trying to learn why something might work, you should also ask yourself why this thing might not work and what can be done about it. Lesson number 14. Nobody knows the future for sure. Trading is speculation. The term speculation has a bad connotation, but trading is in fact a way of speculating about the future of price in a methodic manner. Various trading methods and techniques aim to increase the chances of success, but it should be clear to you that there is no such a thing as a strategy, technique, or method that will produce 100% positive results. That is not possible since we are dealing with the uncertainty of the future. Lesson number 15. There are mainly three ways of trading. There is speculation, arbitrage, and hedging. Speculation is when traders attempt to predict the future direction of price. Arbitrage is when traders attempt to explore the relation or difference between two or more markets. And hedging is when traders remove the directional element of speculation to explore other property of price like volatility, for example. Retail traders are primarily concerned with speculation, even though there are amazing opportunities to be explored in arbitrage and hedging. Lesson number 16. The transition between market scenarios is never certain. It's easy to come up with rules to trade a sideways market in the same way that it's easy to come up with rules to trade a trending market regardless of price direction. However, it's the transition between these two market scenarios that is a problem. We never know when the market will go out of a sideways phase and enter a trending phase and vice versa. Lesson number 17. Technical indicators have lag. One of the major flaws in most technical indicators is that they have lag. This happens because they condense past price information into the present. That has the unfortunate and counterproductive effect of generating false and inaccurate signals. Traders should avoid most of the lagging indicators or attempt to use them in a non-lagging way, which is also possible. Lesson number 18. It's possible to use lagging indicators in a non-lagging way. Since lag comes from condensing past price information into the present, by ignoring the time axis of price charts, we can transform a lagging indicator into a non-lagging one. That's the case with using moving averages as support and resistance lines, for example. Moving averages are clearly lagging, but if we just use the vertical axis of the chart and ignore their lag, a better use of them emerges. Lesson number 19. Learn stuff outside technical analysis. Even though technical analysis is vast and ever expanding, it's important to learn other approaches like fundamental analysis and macroeconomic analysis. That will provide an even broader viewpoint about the market. There are great traders who combine these broader analytical branches in order to trade successfully. For instance, some traders only act when technical analysis intersects with fundamental analysis and macroeconomic analysis as well, despite the number of already existing intersections of techniques inside the technical analysis viewpoint. Lesson number 20. Most technical indicators are pseudoscience. Most technical indicators are an invention of some trader at some point in time observing empirical evidence about the markets, and because of that, most technical indicators make no scientific sense, even though they seem scientific. There is no established scientific theory that supports any of the technical indicators used by most retail traders. Lesson number 21. There are serious scientific fields that study price behavior. The serious scientific fields that can study price motion and behavior, among other things, are econometrics, nonlinear dynamics, and fractal geometry. Learning these fields will provide the best framework for the understanding of price, but unfortunately, there are very few sources of information about how to use these things in trading. That's what I aim to change with my new upcoming paid courses. Lesson number 22. The self-fulfilling prophecy effect. The greatest point of criticism that the standard theory of finance makes regarding technical analysis is that the fact that certain technical tools can work sometimes because of something called self-fulfilling prophecy effect. This is what happens when too many people start to act as if a certain technical indicator is true, even if this indicator has no scientific grounding whatsoever, which is often the case. The issue is that the financial markets are a type of complex system where predictions about the system alter the system itself. That's called a second-order chaotic system. That's the case with politics as well. If too many traders start to predict that a certain technical tool will work in a certain way, then these traders will act accordingly, and the market will start to react to such tools as if they made sense. It's important to be careful with this, because even though the self-fulfilling prophecy effect is present, technical trading is still the weakest force in the financial markets in comparison to institutional money and macroeconomic events that drive investment. Lesson number 23. Technical indicators are an attempt to solve a nonlinear problem with a linear tool. Most technical indicators have a fatal flaw, which is to give a linear treatment to a nonlinear problem. What I mean by this is that traders have to choose one period for technical indicators, like a 20-period moving average, for example. This period is fixed. However, the size and time duration of highs and lows is variable. That means that the technical indicator will capture price correctly in some points, but it will fail in many other points. For this reason, indicators tend to be a suboptimal solution to the problem of speculating about future price direction. Lesson number 24. There are a few good ideas in technical analysis, but most of it is bad. For market participants that use different methods, technical analysis seems like a religion because it's full of dogma and arbitrary rules. There are countless bad ideas in the theoretical scope of technical analysis, but there are also a few good ideas. Lesson number 25. Retail traders are the weakest forces in the market. Retail traders, most of which use standard technical analysis, are the weakest forces in the market. Funds, hedge funds, sovereign wealth funds, and large banks are much more powerful because they have much more capital at their disposal, and they are not primarily concerned with technical analysis. Some retail traders have the impression that institutions are worried about this moving average or that support level, but the truth is that most institutions are not looking at that at all. There are different uses and different approaches that these institutions use in the market. Lesson number 26. Stop losses must be logical, not arbitrary. Stop loss orders must be placed in an area that makes sense, otherwise they have a higher chance of being triggered. Stop loss cannot be self-imposed. For example, deciding where to put the stop loss based on how much you are willing to lose doesn't make any sense, because the market doesn't care about the trader's individual wishes. Lesson number 27. Risk-reward ratios must be realistic. At some point, traders learn that risk-reward ratios must be large. You want your wins to be big and your losses to be small for a variety of reasons that go outside the scope of this video. However, a few traders take this idea to the limit. They attempt to use risk-reward ratios that are unrealistically high, like 1 to 10 or 1 to 20. The problem with that is that traders must do what works most of the time, not what works once in a while. A trade with 1 to 10 risk-reward is great, but generating trades like this on a consistent basis is almost impossible. You will be much better off aiming at 1 to 3 in most trades. That's a case where less is more. Lesson number 28. You can make money being wrong most of the time. While most retail traders are trying to find a strategy that produces the highest win rate possible, the few traders who survive in the market do so with a win rate that is usually below 50%. The way that's possible is by using a risk-reward ratio above 1 to 3. With wins many times the size of losses, you can lose most of the time and still make money in the end. That's a lot easier than trying to win all the time, and it has the advantage of propelling traders into the long term consistently. Lesson number 29. Never decrease your risk-reward ratio when the trade is already opened. It's common for traders to plan a trade with a certain risk-reward ratio, and when the trade opens, to change the risk-reward ratio by changing the size of stop loss and take profit targets. You can sometimes increase the risk-reward ratio, but never decrease it while you are in the middle of the trade, because what matters most is the risk-reward that you close the trade with, not the risk-reward ratio that you expected before the trade. Lesson number 30. There is no reward without risk. Some traders like to believe that there are risk-free strategies out there. There is no such thing. Every potential reward is associated with a risk. In fact, even not taking risks at all is also a risk. The risk of missing opportunities. You are taking risks whether you realize it or not. Lesson number 31. Don't treat the market as if it was the lottery. Certain traders with a specific type of personality, a specific goal, and a specific level of knowledge will attempt to become rich quickly in the financial markets with the excuse that they will do so with skill rather than luck. The problem with this is that even though skill is certainly part of trading, it's impossible to remove the element of chance from it. Those who play with chance will eventually get what they deserve, which is financial ruin. In fact, if you want to become rich quickly, you are much better off playing the lottery. You will waste less money and less time than trying to do that in the market. However, treating the market as if it was a lottery is a terrible mistake. Lesson number 32. The market is not a casino. The financial market is not a place to gamble or a place to try recuperating losses by going all in. This is gambling and addictive behavior that always ends in the same place, which is absolute financial ruin. Lesson number 33. Losing streaks do not increase the chance of winning. Some traders believe that the deeper they go into a losing streak, the higher the chances of a winning trade happening. This is unsubstantiated folk wisdom, or folk stupidity, I should say. The outcome of one trade is not connected to the outcome of the last trade you made, and it's not impossible to generate unusually long losing streaks. This belief is called gambler's fallacy, and throughout the years, many irresponsible traders have used it as an excuse to use all kinds of terrible ideas in the market, like martingale betting systems. Lesson number 34. A winning streak does not increase the chances of winning further. The other side of the gambler's fallacy is when traders believe that they are in a roll because of a winning streak. The reality is the same of the gambler's fallacy. The outcome of your current trade has absolutely nothing to do with the outcome of your last trades. They are independent of each other. This belief that winning streaks increase the chances of winning further is called hot hand fallacy, and is part of the reasons that create overconfidence in winning traders. Lesson number 35. Do not use martingale betting systems to trade. A martingale betting system is not a risk management style. It's a betting system. It came from gambling. It involves doubling down losses until a win occurs. Eventually, a win will occur, but what martingale users neglect is that this system assumes you have infinite capital. Doubling down losses will over-leverage your trades with an insane speed. For instance, by the 5th time you double down, your trade is already 32 times larger than the first one. By the 10th time, your trade will be 1,024 times the size of the first one. In summary, leave betting systems for gambling. The financial market is a place for knowledge and responsibility. Lesson number 36. Leverage is a position sizing tool, not a drug. In today's market, several brokers offer insane amounts of leverage for the unadvised retail trader. Leverage is supposed to be a position sizing tool, meaning a tool to contract or expand the risk you take in your trades so that every trade represents the same percentage risk regardless of the stop loss size, for example. However, leverage has a dark side, which is that it can be used to over-leverage trades in the attempt to produce astronomical returns in a short amount of time. This is a bad idea. It leads to a pathological scalping mentality that will destroy your financial life, not to mention the bad psychological effects in the long term. Check out my Ultimate Beginner's Guide to Scalping if you want to learn more about this. Lesson number 37. Leverage is the #1 killer of retail traders. Over-leveraging is probably the #1 reason why many retail traders break one account after the other, and many become addicted to the feeling of producing high returns. This feeling has a huge psychological and financial cost though. Eventually, the trader will also produce astronomical negative returns that will put the trader in a dangerous psychological slippery slope. In summary, don't use leverage as if it were a drug. It's just a position sizing tool. Lesson number 38. You never know how much you're going to win, but you have the obligation of knowing how much you can lose. The majority of new traders tend to focus on how much they will win with a certain strategy, and they forget to think about how much they can lose. In trading, you never know how much you're going to win, but you have the obligation of knowing how much money you can lose. Just thinking about winning is unrealistic and immature. Traders must remember that everything has a good and bad side, and losing is part of trading. It will happen no matter how good you get. Lesson number 39. Higher returns are not necessarily better. Most people who begin trading believe that the higher the return they produce, the better their performance. This is not true at all. What matters the most is the amount of return per unit of risk that a trader assumes. This is known as risk-adjusted return. It means that the trader is able to squeeze the most amount of positive return with the least amount of risk. That creates counterintuitive situations where traders with lower returns can have a better performance than traders with higher returns. Lesson number 40. Risk is the standard deviation of returns. Retail traders often have a qualitative perception of risk, but risk can also be seen quantitatively. It's the standard deviation of returns, meaning how much the individual returns of a trader tend to deviate from the mean of returns. That's an incredibly important intuition to have. Leverage, for example, increases the standard deviation of returns, and this is the reason why it's so dangerous. The standard deviation of returns is also highly correlated with the intensity with which a trader feels emotions. Strategies with a high standard deviation of returns will produce higher levels of anxiety, anger, greed, fear, and etc. Lesson 41. There are countless ways of being misled by your own performance. Many traders believe that simply making money means success. The reality is not so simple. We have to take into account the time horizon of returns, the risk-adjusted metrics, the amount of data that is being used to measure the performance, and many other variables. The reality of performance measurements or performance appraisal has surprising and counterintuitive aspects. A trader who's losing in the short term might be on the right path, while a trader who's winning in the short term might be in the wrong path. This is why it's extremely important to learn proper performance measurement. Lesson number 42. Strategies behave differently in different time horizons. One intuition that is not obvious at all is that trading strategies produce different results depending on which time horizon you analyze them. For example, a strategy might appear to be extremely profitable in the short term and fail completely in the long term. The opposite is also true. A strategy can seem to be bad in the short term, and produce consistently profitable results over the long run. Lesson number 43. There are more than 60 metrics to assess risk and performance. The fact that there are more than 60 metrics to measure risk and performance is evidence that measuring performance is not so simple. There are all kinds of mathematical and statistical traps a trader can fall into when attempting to learn if his results are consistent, if they are better than a benchmark, and if they are the result from skill rather than mere chance. Lesson number 44. There are scientific fields that study trading psychology. Trading psychology is an expression invented by traders. It doesn't exist in the scientific literature. The sciences that study the so-called trading psychology are behavioral economics and, more recently, neuroeconomics. Behavioral economics attempts to explain economic behavior under the guiding light of psychology. Neuroeconomics attempts to explain economic behavior under the light of neuroscience. Lesson number 45. Learn about cognitive biases. One of the most useful aspects of behavioral economics is learning about cognitive biases, which are innate errors of judgment that all human beings have. By knowing how these biases affect us in various ways, traders can avoid many of the traps that inevitably occur in trading. This is not only useful for trading, but for life in general. Lesson number 46. We are not rational when it comes to financial decisions. For the longest time, the neoclassic economic theory assumed that human beings were perfectly rational, which is self-evidently not true. Out of this notion, behavioral economics emerged to study how flawed our perception really is, and how irrational we can be when we face decisions that involve financial risk and uncertainty. Learning about these matters is a humbling experience, to say the least. Lesson number 47. Learning behavioral economics will beat overconfidence out of you. One of the ways to humble yourself is to get in direct touch with your own limitations. That's what the study of behavioral economics does for you. You begin to understand the flaws that all humans have, and also that you are not different from any other human, regardless of how smart you think you are. Cognitive biases have nothing to do with intelligence. They sort of precede intelligence or personality in a way. If you truly understand that, overconfidence becomes healthy skepticism. Lesson number 48. Hyperbolic discounting. Hyperbolic discounting is perhaps one of the cognitive biases that most influence traders' behavior. It's the tendency to prefer smaller and immediate rewards over larger and future rewards. That doesn't make any sense because larger rewards are better if we are talking about the same risk level, but the time component makes people prefer the immediate gratification. Delaying gratification is uncomfortable, so people rather sacrifice the size of rewards to avoid this discomfort. However, that decision is not rational at all. Hyperbolic discounting leads people towards scalping and eventually to addictive behavior in the markets. Lesson number 49. The Dunning-Kruger effect. The Dunning-Kruger effect explains why traders who know almost nothing about the market feel overconfident in their decisions, and seasoned traders are always skeptical. According to this bias, the less a person knows about a subject, the more she overestimates her ability. As more knowledge is obtained, the person begins to understand the true complexity of the matter, and overconfidence starts to be replaced by a healthy dose of skepticism. Lesson number 50. Trading incorrectly produces a whole spectrum of negative emotions. When trading is done incorrectly, it has a wide range of emotions such as excitement, euphoria, anxiety, fear, denial, fear of missing out, panic, greed, confusion, desperation, overconfidence, underconfidence, hesitation, impulsivity, anger, agitation, and many others. These are all emotions that appear when traders attempt to make money quickly and when they begin to pursue immediate gratification in the markets. The trick here is not to try and manage these emotions. It's to avoid them completely in the first place by using reasonable risk levels, training the art of consciously delaying gratification, and training to have patience, not to mention to enrich your knowledge about human behavior in the face of decisions that involve risk and uncertainty. Lesson number 51. You can dial down all negative emotions by risking less. The truth is that all negative emotions that emerge in trading have a strong positive correlation with the risk level. The more you risk, the more you amplify your emotions. If you risk beyond a certain threshold, your brain will start to sabotage your behavior as a defense mechanism. Needless to say, this never ends well. By decreasing the amount of risk you take, you dial down all the negative emotions to a manageable level. Lesson number 52. The amygdala hijack. When traders are desensitized to risk and begin to risk way beyond what's considered to be the appropriate risk level, the danger-sensing part of the brain will sabotage the trader's behavior as a defense mechanism. The part of the brain that does this is called amygdala, and it resides in a brain region called limbic system, which is responsible for emotions, roughly speaking. The problem is that when the amygdala senses danger, it can override another brain region called neocortex, which is responsible for abstract thinking and reasoning. This is known as amygdala hijack. In clear terms, if you expose yourself to too much risk, the thinking part of the brain is shut down by the emotional part of the brain. From that point onwards, only bad things can happen because the more primitive parts of the brain that act as a defense mechanism didn't evolve to trade the markets. Lesson number 53. Do not revenge trade. Revenge trading is when the trader gets upset about losing and then tries to recuperate his money back as if the market was the reason why he lost. This is a mixture of denial, anger, and impulsivity that always ends badly. First of all, if you lose money, you need to understand that it's part of trading. No trader has ever produced only winning trades. It's not possible. The outcomes of trading are a mixture of skill and chance. A good trader is the one who will maximize the role of skill and minimize the role of chance in the outcomes, but it's certainly not possible to remove chance from this equation. Thinking that the market is against you is as delusional as thinking that the universe conspires against you. The moment you decide to trade is the moment you accept the responsibility of losing money. Everything that happens after that is your fault. Beyond that, blaming others for failure never led anyone anywhere productive. Lesson number 54. Do not overtrade. Many retail traders believe that the market is an endless stream of opportunities and that they can open the charts at any time and find high-quality trade opportunities. Nothing could be further from the truth. High-quality trade opportunities don't happen all the time because several different factors must coincide for that to happen. Overtrading is just an attempt to avoid the boredom of trading correctly. It will lead to a lot of bad trades, plus a lot of spreads and commissions. Lesson number 55. The slow way is the fastest path. The fastest way is the impossible path. People are always after the easy solution that will lead them to the final result without paying their dues. That's certainly true in trading. Traders want to become rich quickly, and when they are learning, they want to disrespect the appropriate learning curve because they are in a hurry. If you are in a hurry, you should not be trading at all. If you want to become rich quickly, you should play the lottery instead. And guess what? You will probably not win also. Ironically, when you try to cut corners, you end up taking longer to reach your goals because you will keep getting catapulted back to the starting position. The fastest path to your goals is actually the slow way. Lesson number 56. The scalping mentality will lead you to addictive behavior. Nowadays, the combination of electronic trading, high leverage, and poor financial education has made scalping a dominant reality among retail traders. Scalping is so terrible that I created an entire free course just to expose its problems, which you can check out in the video card. The point here is that the scalping mentality, especially when combined with leverage, will lead you to addictive behavior, and that's a great way for you to lose everything you have, so you should avoid it at all costs. Lesson number 57. The market doesn't care about your feelings. This is the financial version of facts don't care about your feelings, which is a tough but real statement. Traders must realize that the markets work in a certain way, and it's the trader's responsibility to learn what this way is. The better you tune your expectations with the reality of the markets, the less you will be frustrated with your outcomes. That's true not only in trading, but in life in general. Your feelings and opinions might not have anything to do with the way things actually work in reality. The role of knowledge and experience is to get you closer to that reality and away from biases and alienation. Lesson number 58. Looking for the Holy Grail is a fool's errand. People who look for the Holy Grail in the markets fail to realize that if such a thing existed, it will become popular very quickly, and in the markets, when everyone sees the same opportunity, it vanishes away. Beyond that, Holy Grail seekers think that the Holy Grail not only exists, but it's also very simple to understand and use. It's hard to imagine something that is more immature and unrealistic than this. Once again, this is just people trying to cut corners and avoid the pain of doing things correctly. Lesson number 59. Trading is not just about discipline. You often read in trading blogs that the trading strategy that you use is not important. What matters is your discipline in following it. This is wrong. There are bad strategies and there are good strategies. Following a bad strategy with discipline will only create consistent losses. You must be disciplined for obvious reasons, but the strategy, technique, or method that you use must be good also. Lesson number 60. Good trading is about trade location, not about win rates. On the internet, you often see traders relentlessly looking for a strategy that yields a super high win rate. But the problem is not trying to find a strategy like this. The problem is that this is not what these traders should be looking for at all. Win rate means nothing without the context provided by risk-reward ratios. Good trading is about good trade location, meaning entering the trade near a reversal point with a small logical stop and a large potential reward. Once again, you can break accounts repeatedly with 99% win rate, and you can be consistently profitable in the long term with a 35% win rate. What matters most is the trade location. Lesson number 61. Good trading is also about delaying gratification. Trading with good risk-reward ratios implies a problem. The target is far away from the entry, and the moment the trade enters profitable territory, you will be tempted to close it with a small profit. That's hyperbolic discounting in action. You have to purposefully delay that gratification in order to reach the target, even if that means the trade returning to losing territory. If you don't learn how to delay gratification, you will never produce trades with risk-reward ratios large enough to sustain you through the long term. Lesson number 62. Read about trading, but be careful. Most traders make the mistake of not reading about trading. There are countless books out there with tons of information. However, you must be careful. A lot of these books are superficial and misleading. One of the ways you can tell if a book is good or not is by seeing if the title makes unrealistic promises. If it does, it's probably a bad book. Books that refer to specific aspects of certain techniques or methods are usually better. Lesson number 63. Retail scalping is terrible. Institutional scalping is awesome. Retail scalping is the type of scalping where directional trading is used along with bad risk-reward ratios, meaning large stops and small targets. That idea is so bad that I created a whole free course to expose it. However, institutional scalping is amazing because it's non-directional and it explores volatility, which has very useful properties. The conceptual framework of institutional scalping is also superior. It's what certain people would call anti-fragile, meaning that it profits from the only thing that is always present in the markets, which is uncertainty. It's no wonder why this is done by institutions. I have 3 ebooks about institutional scalping: volatility trading, gamma scalping, and vega scalping. You can check them out in the video description. Lesson number 64. Backtest your trading ideas. In real time, trades take some time to develop. Sometimes they take a lot of time. If you want to practice some aspect of your technique, try to backtest your ideas using TradingView Replay feature. Don't just scroll your charts back, otherwise you will be subjected to the hindsight bias. On the other hand, waiting for trades to develop in real time is a good way of practicing your patience. Lesson number 65. The perfect strategy doesn't exist because the future is always uncertain. When you trade, you are speculating about the future, and the future is always uncertain to some degree, sometimes more and sometimes less. but uncertainty never leaves the equation. The only certainty in trading is that uncertainty never dissipates. The sooner you get used to this notion, the closer you will get to the truth of trading. Lesson number 66. Don't expect to win every day. If you are a day trader, you cannot expect to win every day. Trading is composed by good and bad days, good and bad weeks, good and bad months, and good and bad years. What matters is winning more than losing. It's impossible not to lose. Even big hedge funds and large banks have bad days, weeks, months, and years, so it's reasonable to expect that retail traders also will. Lesson number 67. Do not ignore your daily goals if you reach them. It's not uncommon for day traders to ignore their goals when they reach them. That's true for both winning and losing goals. If a trader reaches a certain profit goal, he will tend to get greedy and continue trading believing he is in a roll. If the trader reaches a loss goal, he can sometimes attempt to continue trading to recuperate losses. This is the case especially if these goals are reached early in the day. Needless to say, if you're going to disrespect the rule you created yourself, there is no point creating the rule in the first place. Lesson number 68. Study the losers and the winners. 99% of traders don't study what happened with their trades, profitable or not profitable. That's a terrible mistake. Your mind works differently before, during, and after the trade. After the trade is done, you tend to have more clarity and you can see mistakes that you would not be able to spot in real time. You must learn to dissect every single move you make before and during the trade. That's the only way to master this craft. If you're not willing to do this, maybe you don't want to succeed that badly. Lesson number 69. Practice with a demo account. A demo account serves the purpose of allowing you to test how technically sound is your strategy and or how skilled you are from a technical perspective, eliminating the emotional components of risking real money. If you jump straight to a live account, the emotional component of risking real money will get in the way of your still developing technique, and that can only produce confusion. The demo account is an absolutely necessary step. Lesson number 70. Be careful if you have an impulsive personality. Traders vary greatly in their personalities, and unfortunately, some personality types are less suited for trading than others. For instance, if you have an impulsive personality, you will be more prone to the addictive temptations of scalping, and once you enter that road, it will be difficult to get out of it. I'm not saying that traders with an impulsive personality cannot succeed. What I'm saying is that they will have a hard time with certain temptations that appear in the trading world. Lesson number 71. Don't blame a failed scalping strategy on brokers. Scalpers who lose their shirt in the market love to blame brokers with delusional ideas. Things like brokers being able to change the outcomes of your trades or charging unnecessarily high commissions and spreads. If your broker can change your trades, it's not a broker, it's a scam. Second of all, you already know the commissions and spread sizes before triggering any trades, or at least you should know. And third, you're not supposed to open a trade every 30 seconds. That will eat your account slowly but surely. Lesson number 72. Trading is not a way out of poverty. If you are trading because you want to go out of poverty, you will waste your time. Trading is a game for people who already have some financial stability, meaning people who already can afford losing some money and still have left to pay for bills and so on. Do not focus on the stories you hear about traders who went from $100 to $1 million. Even if this is true, which it probably isn't, these are extremely rare exceptions. The rule is that the overwhelming majority of people who attempt this will lose, and you certainly don't want to be one of them. Lesson number 73. Banks use the financial market to hedge credit risk. The main way banks make money is by providing credit. However, there is a huge risk associated with that. For this reason, banks will try to mitigate some of this risk by engaging in the derivatives market. That's the main way banks use the financial markets. Not exactly to profit, but to hedge their main source of income. Stop trying to come up with conspiracy theories about how banks are after the positions of retail traders. Large traders and whales might attempt to legally manipulate price in certain points, but that's a very different story. Lesson number 74. One of the most common strategies used in funds is statistical arbitrage. Funds use all kinds of strategies, approaches, and methods. One of the methods that have stood the test of time is called statistical arbitrage. The idea behind it's so powerful that it won a Nobel Prize in economics. That's not something you can say about 99.9% of strategies out there. If you want to learn more about it, get my book called Statistical Arbitrage by Co-Integration in the video description. Lesson number 75. Trading volatility is easier than directional trading. Nobody knows where price is headed. Traders can only make calculated speculative moves in order to find out. Volatility, however, has some very interesting properties that any directional trader would love. This is why it's interesting to learn how the derivatives market works. If you want to learn more about that, buy my ebook called Volatility Trading. Lesson number 76. Arbitrage is easier than directional trading. Arbitrage is all about exploring the difference between two or more markets. There are many ways of doing that. This difference usually has some interesting statistical properties that make it easier than speculating about the future direction of price, which is by far the most difficult thing you can do, and ironically, the first choice of most retail traders. Lesson number 77. There is a way to make money regardless of what direction price goes. The elegant mathematics of derivatives allows traders to profit regardless of market direction. That's an extremely attractive idea to any directional trader for obvious reasons. The trick is to understand how the hedging of linear and nonlinear markets work. It's a bit difficult to learn, but it's easier to apply than directional trading. Once again, you can learn about that in my ebook Volatility Trading. Lesson number 78. Volatility rises quickly and falls slowly. The inverse of price. Price falls fast and rises slowly. Volatility rises fast and falls slowly. There is an inverse relationship between price and volatility. That's certainly the case when we look at higher time frames of a market index, for example. A slow rising market means trust in the economy and a sense of certainty about the future. A market in free fall means uncertainty. Certainty dissipates a lot easier than uncertainty. Lesson number 79. Retail trading is not a job. Get over it. Many people are attracted to the financial markets believing that they will work from home, but retail trading is not a job. The reason for that is that the outcomes of trading are non-deterministic, while the bills you have to pay never fail to arrive. Beyond that, a real trader can only count on his performance. He cannot count on a deterministic source of income like the administration fees of a fund, for example. If you want to know more about this, check the Ultimate Beginner's Guide to Scalping in the video card. A job is when you provide value to someone else in exchange for money. Retail trading is merely capital gain from speculation. If you want to work with trading, you need to be hired by an institution like funds or banks. Retail trading is only supposed to be a hobby or a parallel source of non-deterministic income. You should never rely on trading as a main source of income to pay your bills. Lesson number 80. All worthwhile endeavors are difficult, but not all difficult endeavors are worthwhile. Some traders like to believe that they are on the right path simply because they are employing some effort and experiencing some difficulty. These traders must remember that all worthwhile endeavors are difficult, but not all difficult endeavors are worthwhile. For example, you might have a sense of purposeful suffering while acting incorrectly. That's a very dangerous road to go down to because you keep insisting on bad behavior with the excuse that you are doing something difficult. To be blunter, hitting your head against the wall repeatedly will hurt a lot. It's a very difficult thing to do, but it has no purpose. Just because what you're doing is difficult doesn't mean you should be doing it. Lesson number 81. Don't use multiple time frames in contextual analysis. Over the years, traders become used to the idea of jumping around between time frames in order to collect more information to analyze the markets. That's valid in certain types of trading, but if you do that with contextual analysis, you will shoot yourself in the foot. In order to make an appropriate contextual analysis of the market, you need to restrict the amount of information you use and choosing that information is part of the art of trading, so to speak. If you jump around between time frames, it will dramatically increase the amount of information you have to articulate, and you will eventually suffer from analysis paralysis. Lesson number 82, analysis paralysis. Analysis paralysis is when you try to apply too many ideas and techniques in your analysis to the point where you cannot take action. That's one of the problems of more sophisticated trading approaches. Once traders learn how to extract the maximum amount of information out of price charts, the amount of information will become overwhelming, and then the necessary skill to master is the filtering of this information. Lesson number 83, the paradox of choice. Analysis paralysis relates to something called the paradox of choice, which is when an increase in the number of possible choices decreases one's ability to choose. If you know too many techniques and you have too much information about a certain piece of price, you will have some difficulty making decisions about it. However, in order to see high-quality trade opportunities, you need this higher level of information. The only way out of this is to learn how to filter out the information. Lesson number 84, market cornering. It's possible for one individual or a small group of powerful individuals to take control of a small market. This is known as market cornering. The only thing that separates an individual from the possibility of cornering a market is capital, and the knowledge of how to do that, of course. The point here is that the mechanism of supply and demand that underlies all markets make it possible for one individual with a lot of capital to take control of the market in certain points. This is also known as market manipulation. The individuals that do this have been referred to as whales or market makers, although the term market maker has the connotation of liquidity provider in the institutional domain. If you want to learn how to profit from this notion, check out my market maker trading strategy in the video description. Lesson number 85. Beware the tripod of failure: denial, lack of education, and stubbornness. A few of the worst attributes that a trader can have are denial, lack of education, and stubbornness. The combination of these three elements together will guarantee absolute failure. That's why I call it the tripod of failure. Denial will blind the trader to his own limitations. Lack of education will isolate the trader from the realities of trading, and stubbornness will keep the trader committing the same mistakes over and over again. If that sounds familiar to you, it might be the time to stop and reevaluate. Lesson number 86. An unrealistic plan is a great way to avoid progress. Traders love to make unrealistic plans about how they are going to follow all these rules, make all this money, and trade for an unreasonable number of hours in a day. That's a great way of throwing away time and effort. A plan is only as good as its level of realism. If you cannot put a plan into practice, it defeats the whole purpose of having a plan in the first place. Lesson number 87. Aim low and far instead of high. New retail traders will often make unrealistic plans about how much money they are going to make and how fast they are going to make it. Needless to say, this is a vain exercise. Instead of aiming high, you should aim low and far. That does not mean you should not be bold or ambitious. It means that you should aim for the long term while being realistic in the short term. Slow progress beats the hell out of no progress at all, which is what happens when you keep trying to make things happen quickly. Lesson number 88. Discipline is not about willpower. It's about habit formation. Many trading educators talk about discipline and the fact that you should have discipline to trade. Nothing could be more obvious than that. Of course you need to be disciplined. The issue is how to be disciplined. The guideline that you should be disciplined implies that it's about willpower, but that's incorrect. Discipline is about realistic habit formation. The formation of a strong habit in your life will actually change the physiology of your brain, something called neuroplasticity. Once that new brain circuit is established, it's easier to be disciplined than to break the habit. The trick, however, is in how you create good habits and destroy bad ones. The trick here is to make small incremental steps. Lesson number 89. Trading has a massive opportunity cost. Trading has a massive opportunity cost in terms of time and money. So if you're going to trade, you need to make sure you are beating the market in the sense that you are performing better than a benchmark. However, be careful with how you measure your performance against the benchmark. Higher returns are not necessarily better returns. If you cannot perform better than the benchmark, then you will be better off by simply investing your money in the benchmark, then using the time you are going to use to trade to something else. Beyond that, spending hours in front of the computer in order to trade means you don't have a job, and you cannot substitute a job with retail trading. Lesson number 90. There are a few Nobel Prize winning ideas that traders should be aware of. Over the years, there has been a few Nobel Prizes that every trader should be aware of. I'm not going to go into detail about them in this video, obviously, but the small list should motivate you to go after these ideas on your own. I have the Black-Scholes model, which I have a video about in the channel, the Sharpe ratio, the co-integration model, and the autoregressive conditional heteroscedasticity model, and the prospect theory. There are a few others, but I judge these to be the most important for trading. Learning about these ideas will change your view of the markets forever. Remember that no idea ever earns a Nobel Prize without changing science in a fundamental level. Lesson number 91. Trading is not about going after opportunities. It's about being in front of them when they appear. Beginners will often enter the markets believing it's some sort of mechanical job, and because of that, they act as if the trader should go after opportunities. That's the wrong way of looking at it. Trading correctly is about being in front of the opportunities when they appear, which is a very different thing. Trading is about being patient like a hunter, waiting for the exact moment to pull the trigger. It's not an assembly line where you perform a mechanical job and receive a paycheck at the end of the month. Lesson number 92. Retail scalpers are useful liquidity and volatility providers. Scalpers who like to use a lot of leverage are very useful for other market participants that require liquidity and volatility. Large numbers of high leverage scalpers create a lot of liquidity because they keep throwing money in the markets to sustain a scalping vice, and leverage positions inevitably create more volatility. Liquidity and volatility are precisely the two things that volatility traders and banks seek. These types of traders thrive on uncertainty, chaos, and turmoil. If you want to learn how that's possible, check out my institutional trading ebook called Volatility Trading. Lesson number 93. The 10,000 hours rule. At some point in your life, you probably have heard about the 10,000 hours rule, which states that it takes an average of 10,000 hours of intense practice in order to master complex skills. That's between 2.5 and 3 hours per day, every day for 10 years. That's if you want to become a master. It doesn't mean you'll need all of that to make good trades. However, you cannot expect to make good trades by using something you learned over the weekend. Nowadays, you find all sorts of unrealistic promises on the internet. Things like become a professional trader in 3 steps or any other type of nonsense like that. Trading is complicated and it's also multidisciplinary. It requires serious study and practice. The sooner you accept this reality, the sooner you can achieve better results. Lesson number 94. There is a connection between financial markets and physics. The standard theory of finance assumes that price follows what's called Brownian motion, which is the type of motion of a dust particle in collision with water particles inside a glass, for example. This notion set the stage for the understanding of price behavior, but it was also studied by Albert Einstein in a different context. Einstein's studies motivated another physicist called Jean-Baptiste Perrin to win the Nobel Prize in Physics for proving the atomic nature of matter. Both the Nobel Prize for the Black-Scholes model in economics and the Nobel Prize in Physics for the discovery of the atomic nature of matter share this intuition of Brownian motion. That's the deep connection between physics and finance. Lesson number 95. Financial markets and hydrology. Certain schools of thought consider that price has a memory. The calculations that allow one to assess this level of memory are the same types of calculations used in hydrology. This became famous in the Nile River project when the hydrologist Edwin Hurst developed a way to demonstrate that apparently random data presented long-term memory. This is something that goes directly against the standard theory of finance that assumes price follows what's called a Markov process, meaning that the only price that matters for tomorrow is today's price. Everything else that comes before that is irrelevant. Lesson number 96. Markets are fractal. The Greeks invented the geometry of perfect forms, known as Euclidean geometry. That's the one you learn in high school. However, in the real world, perfect geometric shapes are rare if not existent. Objects and shapes in the natural world are imperfect and rough. We can certainly see that in the markets. Geometrically speaking, price is rough, imperfect, and self-similar, meaning that it repeats inside itself across many scales. Trying to apply Euclidean geometry on that is hard. It's better to use another type of geometry called fractal geometry. The fact that markets are fractal opens up a host of different possibilities inside technical trading. Lesson number 97. Markets are not part of nature, they are part of culture. You often hear that financial markets are part of nature in order to justify some sort of trading technique like Fibonacci, for example. However, markets are not part of nature, they are part of culture. In other words, the logic of supply and demand only emerges in a society that believes that a market economy is the more appropriate way of allocating resources efficiently. Lesson number 98. Markets are chaotic systems. For a system to be classified as chaotic in mathematical terms, it must display aperiodic behavior at the same time that a deterministic rule exists at the bottom. That's certainly the case with the financial markets. We have apparently chaotic behavior in price, but the basic logic of supply and demand is deterministic. The fact that markets are chaotic opens the possibility of using nonlinear dynamics to study price, which is very useful. Lesson number 99. Price follows Brownian motion. Price is known to follow something called Brownian motion, which is the random path produced by a particle in collision with many other surrounding particles. This notion really changed the way I look at the markets because it made me go after the origins of this idea. From this point onwards, I began studying derivatives, the Nobel Prize winning ideas related to this notion, quantitative trading, and my overall level of understanding of deeper subjects got better since I started to go after more difficult things to learn. This is your chance to do the same. Lesson number 100. Your mind has the tactical advantage over you. In the final lesson, I want to talk about something related to the battle of you against yourself. You have to remember that your mind has the tactical advantage over you, meaning that you cannot hide your fears and insecurities from your own mind. It knows it all. The point here is that if you decide to ignore the things you know you should be fixing right now, your mind will eventually sabotage you. That's where failure comes from. You must have intellectual honesty, accountability, and transparency with yourself at all times. For example, deep down, you actually know you should not be trying to make money quickly in the market. And if you don't know how to explain why that is, I'm sure you have the intuition, and yet, you still go and try it. That's what I'm talking about here. Do not do things you're not supposed to do just because you cannot see another way, or because you are trying to avoid the suffering of doing things correctly. You should try to face the suffering of doing things the right way, because on the other side of this suffering, there is the most amazing sense of accomplishment you'll ever feel. You cannot achieve this feeling of accomplishment by cheating. This finishes the 100 powerful lessons I learned over 15 years of trading. I hope you realize that there is a lot of good stuff you can extract out of this video, even if you don't quite get what I mean by some of these lessons yet. Take your time to watch this video and really soak in the information. In fact, I would encourage you to watch this or listen to this every night before you go to bed. Engrave these pieces of information in your brain, and I guarantee you will save a lot of money, time, and effort in the markets.